Every trader dreams of having a setup that delivers consistent opportunities, something you can rely on no matter what the market throws at you. Imagine starting each trading day with a clear plan, a precise method, and the confidence to execute trades that follow a repeatable edge. Today, we're going to break down a powerful scalping strategy that has the potential to work every single day. This isn't a magic trick or some secret indicator. It's a structured approach rooted in price action, market timing, and sound risk management, concepts taught by the Inner Circle Trader, or ICT, and refined into a strategy that can fit into any disciplined trader's toolkit. By the end of this video, you'll understand every element of the method, from when to trade, to how to enter, to where to protect your capital. If you're serious about becoming a consistent scalper, this deep dive is for you. Now, before we start unpacking this strategy, remember nothing shared here is financial advice. Trading involves real risk. Your decisions are your own, and it's critical that you practice thoroughly and understand the risk before trading live money. This content is for educational purposes only. With that said, let's get into the mechanics of a scalping strategy designed to give you a reliable framework, one that you can execute again and again, day after day. Consistency begins with preparation. Scalping is all about speed and precision, but ironically, it starts long before the market opens. The first step is identifying your macro time windows, specific periods during the trading day when volatility is most likely to give you clean, tradable moves. ICT refers to these as macros, and they're essential. For this strategy, we focus on the New York session because that's where liquidity and participation reach their peak. The morning session provides multiple high probability windows. Common macro periods include 750 to 810, 850 to 910, 950 to 1010, and so on, with additional opportunities into the late morning and early afternoon. These windows aren't random. They're when algorithmic programs and institutional players are most active. By aligning your trades with these periods, you dramatically increase the odds of catching meaningful price movement instead of getting chopped up in low volume noise. But time is only half the equation. You also need a directional bias. Each morning, study the higher time frame charts to determine whether the market is likely to seek liquidity above or below. Is there a clear trend? Are there obvious highs or lows from previous sessions that price might be drawn to? Liquidity is the magnet, and your job is to anticipate where price is most likely to hunt for stops. With your macro window and directional bias in place, it's time to watch for the heart of the setup, the stop hunt. This is where the market moves sharply to take out obvious highs or lows, triggering stop losses and luring traders into the wrong side of the trade. Scalpers love this moment because it provides the liquidity needed for a swift reversal. As price spikes above a recent high in a bearish scenario or below a recent low in a bullish one, watch carefully for what ICT calls the inversion. This is the first confirmation that the stop hunt is complete and that the market is ready to reverse. The inversion is often a candle or series of candles that fails to continue in the direction of the hunt and instead begins to close back inside the previous range. For our strategy, a candle closed below the fair value gap, low in a bearish setup, signals that the imbalance created by the stop hunt is now being filled. Your first potential entry comes as the next candle opens. This entry is precise, but it's not the only opportunity. If the initial move continues to develop, look for a second confirmation, the breaker. A breaker is a failed high or low that becomes a new resistance or support level. Once price closes below the breaker low, in a bearish case, the next candle open provides another high probability entry. These two layers of confirmation allow you to scale in with confidence while keeping risk tightly controlled. No strategy is complete without strict risk management. For this setup, the stop loss is placed just beyond the high of the stop hunt, or slightly above the inversion level if that provides a cleaner technical barrier. The beauty of scalping is that your stops can be extremely tight, often just a few ticks or pips, because you're trading a very specific pattern in a defined time window. The profit target is equally methodical. Aim for at least a 1-to-2 risk-to-reward ratio. That means if your stop is 10 points, your target should be 20. This ensures that even if you only win half your trades, you remain profitable over time. Remember, scalping isn't about catching massive trends. It's about stacking small, consistent wins while avoiding catastrophic losses. Let's walk through a typical day using this strategy. Imagine it's the New York morning session and the S&P 500 futures are consolidating below yesterday's high. At 950, price suddenly surges, breaking above that high in a sharp rally. Retail traders chase the breakout, but this could be a stop hunt. You watch closely. Within minutes, a candle closes back below the fair value gap low. That's your inversion. As the next candle opens, you take your first short entry with a stop just above the high. Price drops quickly, filling the imbalance and breaking below a minor swing low, which forms your breaker. Another candle closes beneath it and you add a second position. Within 20 minutes, you've captured a 1 to 2 risk toward move, banking a clean scalp, while many breakout traders are stopped out. While the technicals are important, success with this strategy depends just as much on psychology. Scalping demands discipline and speed, but it also rewards patience. You must wait for the exact conditions, macro window stop hunt inversion breaker, before entering. Chasing setups outside these parameters leads to overtrading and unnecessary losses. Equally important is understanding that no strategy works every single time. Losses are part of the game. The goal is not perfection, it's consistency. By sticking to a repeatable process with positive expectancy, you allow probabilities to work in your favor over the long term. To recap the flow, each trading day identify your macro time windows and directional bias. During those windows, watch for a stop hunt against the anticipated direction. Confirm the reversal with an inversion candle close through the fair value gap, and consider scaling in after a breaker forms. Place your stop just beyond the high or low of the stop hunt and target at least twice your risk. Rinse and repeat. With practice, this strategy can become second nature. It gives you a clear framework for reading price action and executing trades in real time, something you can rely on day after day. The scalping strategy we've explored today isn't about getting rich overnight. It's about building skill, discipline, and a repeatable edge that can serve you for years to come. Whether you trade futures, Forex, or stocks, these principles remain the same. Time your trades during active sessions, wait for liquidity grabs, and enter with precision when the market confirms your bias. If you found this breakdown valuable, make sure to give the video a like and subscribe to the channel for more in-depth trading education. Your support helps this community grow and allows us to continue sharing professional strategies in a clear, no-nonsense way. Thank you for watching, stay disciplined, and I'll see you in the next video.